Dean, this is the highlight for me every quarter. You come on and you break down the oil markets and the natural gas markets. And for the audience, thank you for all the great feedback and comments you give about having Dean on because he offers a really great perspective. Dean, a lot's changed to say the least since since you were on last quarter. I gotta ask you to unpack it. Let's start with Venezuela. What's the impact of what the situation in Venezuela having on the global oil markets?
Thanks, Grayson. It's great to be back. Look, Venezuela's got a lot of moving parts to it, and we can take the near term separately from the longer term. Near term, it really is about shifting or redirecting barrels. So the country produces about 800,000 barrels per day. A sliver of that has come to the US Gulf Coast primarily. And with sanctions lifted, more of that could come to the US Gulf Coast. So there's a downstream advantage in terms of refining margins of being able to take and process more of Venezuela's heavy oil here at home. In terms of longer term growth, and this is where the market's been grappling with scenarios, it's going to take serious investment. So probably north of $100 to $200 billion over a period of many years to materially increase production back towards what it used to be. At its peak, Venezuela produced over 3.5 million barrels per day. Again, currently around 800,000 barrels per day. So it would take a lot. And the potential's there, but the cost effectiveness in the current price environment, the ability to have it be investable, to put the capital in the ground and trust between fiscal regimes, rule of law, getting the processing, the upgrading, and the transportation in place. There are a lot of moving parts there.
You're looking at investment of 100 to 200 billion, a lot of capital. You still have an unstable political environment today. There's no other way to say it. You have a lack of infrastructure there, but then you also have heavy crude. How does that impact it from a refining capacity? Is it more expensive to refine heavy crude? Is it more expensive to transport? What is the impact of heavy crude?
Heavy crude, first off, the advantage of it is that it gives you denser carbon molecules that have to be broken down to make like products. But that serves asphalt, petroleum coke, waxes, certain kinds of product markets that you just can't serve using lighter oil. So there's that. But it's energy intensive and capital intensive to be able to process that oil. Refiners make dedicated investments to be able to take heavier molecules and break them down. The US Gulf Coast refinery complex there has about 15% of the world's so-called conversion capacity. This is thermal cracking, coking, the ability to take heavy molecules and break them. And so it's got the ability to do it. When we're looking worldwide, though, nearly half of that conversion capacity sits in Asia Pacific. So there's definitely a market, the ability to take it, to process it, and move forward.
With the 50% being in Asia Pacific, how much exactly was in China? Because it's been well publicly documented that Venezuela shipped quite a significant amount of oil to China.
So out of the 800,000, we don't have exact shipments from Venezuela to China, but you can probably guess that half or more of it was probably going that way.
So we also know, and this has been publicly reported, and even the president spoke about that Chevron has had a presence in Venezuela for many years, even during sanctions. And it is my understanding, I'm going to have to fact check this, that they are still there. If they are still indeed there, do we see a scenario where more potential North American oil companies go in there, export that oil, then refine it in the Gulf?
That is a scenario, and I think it could happen. It's going to take, again, enough stability to support the investments that make that happen. Right now, keep in mind the history of U.S. Gulf Coast refining. Venezuelan oil was one of the main reasons refiners on the Gulf Coast and other places invested in the ability to process heavy molecules because it was a cost-effective feedstock source. And it competes mainly against Canadian oil that's coming down from Western Canada. Since 2018, when Alberta was messing with the market and put production restrictions in place, that affected both the trust, the infrastructure investments, everything about taking Canadian oil, where some of the growth opportunity was lost. In mid-continent, in the Chicago area, Ohio, Eastern Canada, they've been able to deal with processing it, kind of taking Canadian crude business as usual. But down to the Gulf Coast, without Keystone XL, without the pipelines otherwise expanding down, you really rely on the margin on rail that adds $5 to $10 per barrel of cost to transport from Western Canada down to the Gulf Coast. So for that reason, and with the production limitations back in 2018, Gulf Coast refiners have adapted to an environment really where they were constrained. They didn't have enough heavy oil to feed all the capacity that they had. They've invested since, and they've adapted to upgrade the bottom of the barrel from lighter refining. So they get heavier molecules and take things like residual fuel oil and make lighter products by upgrading that. That's net how it's worked. This will be an advantage to be able to have more Venezuelan feedstock coming in. It should directionally help refining margins. And over time, it's a question of how much and how fast.
Does this have a long-term potential negative detriment on the Canadian oil sands because all this heavy crude is coming in pretty significant large quantities potentially?
Longer term, directionally, you would say in a static world that it would be downward price pressure on Canadian oil. You kind of saw this actually, the knee-jerk reaction after a couple of days when the capture of Nicolas Maduro was announced. Canadian heavy oil dropped by about 5%. And yeah, that's compared to the broader benchmark for West Texas Intermediate, the lighter oil benchmark, only dropping about 2%. So, twice as much, but that's the crude that it competes directly against, and it made sense. Since then, with all the concerns and the attention shifting to Iran, where we're back above $60 per barrel for West Texas Intermediate and Brent, and things have kind of normalized a bit here, but we'll see where things go. I mean, longer term, the potential is there for substitution, but if you really trust that that's a source, you'll also invest more to process it. So net, we need to see how that plays out.
I mean, this is a purely hypothetical at this point, but let's hypothetically say the Iranian regime falls and that oil comes to the market. What impact does that have? And when I say come to the market, I'm saying that in a unsanctioned, fully legal manner.
It could be a big change. We need to see, and it affects OPEC cohesion as well. And I don't think, speaking out loud here, that OPEC was overly concerned with what's happened with Venezuela. It's just not a near-term issue. Iran would be a different matter, and it affects both oil and natural gas markets globally.
And if you look at, let's say the potential, because it is potential of the Iranian oil coming online, we know the Venezuelan oil is coming online. The bottom line is more oil is coming online, and the EIA recently upgraded their output. They're expecting an additional million barrels per day of demand. It seems, Dean, I'm not an oil economist, but it seems like this is perfect timing. Oh, demand's increasing. Oh, by the way, more oil's coming online. What's the bottom line that's driving this increase in demand?
Well, let's separate out EIA's current outlook. They still have supply outpacing demand in their view. Demand has continued to grow, and it's grown to both a record level and expected to continue to grow over the next couple of years here. So 104, 105, 106 million barrels per day and growing over that period. This is predominantly emerging markets that are taking it for when over 90% of transportation related fuels demand is still oil driven globally. That plus industrial products, industrial processing, all the things that we've talked about, emerging markets, all that economic growth is very oil and energy intensive. So that's continued. Surprisingly, though, the US was also a resounding source of growth last year. If I had told you that gasoline was actually in demand down close to 1% year on year, would you have guessed that overall petroleum demand in the US last year would have been up by close to 1%? Probably not. And the trucking market for diesel fuel was also relatively weak last year. What's really driven that is with the economy, there's a big increase in jet fuel. On the diesel side, it's really diesel generators backstopping and providing power for data centers and AI that are a resounding source of growth. That plus industrial processing. So these things have held up both developed economy and emerging economy demand. And, frankly, you see both with consumerism, growth of incomes, growth of the economy, that continuing to grow.
And then where does petroleum byproducts fit into this growth?
So one of the interesting things, and we'll talk about natural gas markets in a while, is that you get in much of West Texas a lot of natural gas that comes with oil production. And that's been the resounding source of growth as opposed to having dedicated drilling just to produce natural gas. In East Texas and in Louisiana, up in Ohio, Pennsylvania, West Virginia, people look at it as a business where you're doing dedicated drilling to try to produce natural gas. And the break even in doing that might be, $2, $2.50 per million BTU. But when you get natural gas as a byproduct with oil production, it's it has value, but in some cases, and seasonally, especially at the Waha hub in West Texas, there are times 6 months out of the year when the price is negative. It's a waste product at that point, and you have to literally pay people to take it away. So, even currently, it's discounted a few dollars below the Henry Hub benchmark. So, if Henry Hub's sitting at $3.80 per million BTU, you're talking $1 to $2 per million BTU for West Texas gas at that point. So, that byproduct of production or co-product of production has been really important both to the value proposition, the investment you'll make in infrastructure, the market growth. And I see a lot of exciting things really happening with natural gas production, which is also at record levels in the state of Texas there. In terms of processing it, and what you get for different molecules from oil, we talked about the different heavy versus light products. When you export natural gas, you have to take natural gas liquids out of it. So you have propane, butane um, as the main ones. There's ethane for petrochemicals as the largest share of that, and then field natural gasoline or C5 plus, um, more complex molecules that can go into the gasoline pool. With those, though, that is another byproduct, if you will, of natural gas production, where if you're going to export it, you have to take those liquids out. The whole petrochemical base and the investments that have come with cracking ethane, propane can be used for petrochemicals or as a heating source. It's been a boon for the Gulf Coast in terms of being able to process things and produce manufactured goods through the value chain as a result of that energy production.
Is the Gulf Coast is that the largest concentration of energy production in the United States?
Certainly in the United States, yes.
How does that rank from a global perspective in terms of energy creation?
Well, we're now the nation's largest exporter of natural gas and of crude. Excuse me, that both is Texas, but then worldwide, the U.S. is now the number one in both. We've bypassed for crude production. We're to the week 13.8 million barrels per day of crude oil production. The next closest, you're talking Russia and Saudi Arabia at just south of 10 million barrels per day. So there's a big difference. In terms of natural gas, we are now exporting as much as 12, 13. We have the capacity to go up to 15 billion cubic feet per day, and that's growing rapidly. In fact, in the next couple of years, with the terminals that are under construction, Texas will add about 8 billion cubic feet per day of export capacity of just liquefied natural gas. So again, imagine the value chain operating here, and now you're taking a lot of natural gas liquids out. Natural gas liquids US wide are 7 to 8 million barrels per day. Texas is of that, 4.5 million barrels per day. So when you start adding the crude oil production nationwide of 13 to 14 to another 7, you're talking over 20 million barrels per day of liquids. That's a tremendous amount. And most other conventional oil production around the world doesn't come with that degree of liquids out of the natural gas. So that's one of the things that the market has kind of misaligned on over time is discovering the value that goes with natural gas liquids and the optionality, because it can be either a fuel or it can be something that you turn into products.
Fascinating. Is that just because of the way that the land is over there in the Permian Basin in Texas, or is it technology? What's causing this? I'll use the term rapid growth expansion.
So first, let's separate out geology from technology. When we look at the geology of it, West Texas has a high gas content that goes with the liquids, and that's part of why you're seeing that extent of production. In the past, maybe some of that natural gas might have been flared with the oil production or vented, but as the infrastructure is expanded and there's value in the product, increasingly you're continuing to expand the ability to bring that natural gas to market. The Eagle Ford area around San Antonio also has both high liquids and gas content in certain windows. When we get to East Texas, Louisiana, that's more dry natural gas, not much oil, not much liquids, but it's geology that drives that. The technology to produce it, it's less about a technological change enabling it, though the recovery factors, like what percentage of the resource in place can be recovered economically, and being able to do more with less, to produce more despite using fewer rigs, that has, you know, that is a result of efficiencies that have been technology driven. The ability to actually monetize it, though, and find value through the value chain in it is a question of infrastructure and processing investments. So, especially in Texas, the business environment has enabled investments in pipelines. We're adding, by the way, currently under construction, 22 billion cubic feet per day worth of pipeline capacity, mainly from West Texas coming toward the Gulf Coast. And to put that in perspective, the state as a whole last year produced an average of 34.5 billion cubic feet per day of total marketed natural gas. Only about 28 billion cubic feet per day of that was dry natural gas. So 28 of dry natural gas compared with an expansion of 22. Put that in perspective. So it truly is game changing. And this isn't highly speculative, right? This is not a segment of the business that takes tremendous risks. It's underpinned by solid investments, expected market demand. As you're expanding that amount of LNG exports that we talked about, it supports that directly. And as those are underpinned, they really do have contracts in place around the world to be able to place that natural gas. So it really is an expansion that's just in the works, and it's a lot of construction, it's a lot of jobs and value being created in the interim.
And I want to highlight for the audience, you recently penned an article in Bic Magazine about the investment going into the infrastructure. So the audience, I'll link to it, highly recommend. You read it. What's caused that infrastructure investment that you so eloquently detailed in that article you wrote?
Well, one impetus is growing liquefied natural gas exports globally. So there's a need for it. And you can't build those without having a solid understanding of where the supply is going to come from. So the ability to expand the infrastructure gives access to natural gas that otherwise is being produced, but it brings it and gives it market optionality that it otherwise might not have. So that's part of it. The ability to have domestic optionality as well between petrochemicals, from the natural gas liquid side, the growth of natural gas demand domestically, we continue to use more for power, we continue to use more for industry. So those are your main sources. And then on the residential and commercial side, it's really home or space heating, and that's seasonal.
I use it I use natural gas to heat my pool and it does a great job. So thank you to the men and women that work in the natural gas industry. You keep my pool warm. So thank you for that. That aside, how much of the growth for natural gas is being driven by data centers? I read a lot of reports and you see, oh, there's energy constraints. Then all suddenly natural gas shows up, data center gets built. It's common. How much of that's being driven by natural gas?
Okay, in the near term, it's hard to look at industrial demand, where it would show up and pinpoint. We don't have a segmentation of how much exactly. The one thing I can tell you is that as data centers are getting built out, they either have to locate where there is spare capacity on the grid, so additional megawatts that are available, in which case, if they're going to draw on existing plants, natural gas is going to serve an important part of that. And especially the ability, even if there are renewables in place that are serving it, the ability to ramp up and down and have a stable grid through the hours. The other side of this, though, is that in these places in West Texas where we've talked about maybe not enough pipeline connectivity, the ability to co-locate your generation with the data center expansion to have it on site is one of the things. Now, there's a backlog right now in terms of, if you want a natural gas turbine, you might have to wait a couple of years to get it. But with the right conditions and the right supply chain in place, you're putting co-located power source together with the data center. We see some of that continuing to move forward. That's a source of growth as well. So we have north of 7 billion cubic feet per day of industrial natural gas demand in Texas, and especially in West Texas, that's continuing to grow.
It's reported that Texas data center demand could exceed 40 gigawatts by 2028. Staying on the colo theme, could we this is potential. Could we potentially see data centers start to emerge in West Texas where they can co-locate with the energy source?
Absolutely. And I've done some work recently with the University of Texas Bureau of Economic Geology looking at locational factors of data centers. And we can link to that paper as well if you'd like for the readers. But power is one of the key things. Workforce, fiber connectivity, even water. Locational factors do matter besides just power, but power is a gating issue, and that if you don't have it, you really can't move forward. So it makes it attractive. The preference, if the power is available, would be to locate, because of workforce and other issues, a data center with less latency and processing that's close to Dallas or Houston or a major metropolitan area like Northern Virginia. So you're seeing those move forward. But there's also a hot debate right now in power markets over what are the interconnection requirements you want to connect a new large load onto the power grid. And grids across the country are grappling with how to do that. What's the cost predictability? How do you make sure this is an enduring source of new electricity demand? And what's a fair way of having cost sharing to go with that? So different grids around the country are taking different approaches. They're also struggling to go fast enough to meet just a voracious demand for energy in data center and AI processing. So it's coming. Texas is a major part of it. And definitely the ability to co-locate, if you can, is one of the ways of short-circuiting needing to wait for a build out of either generation, transmission, or both.
And I'll say this very publicly, and there's a massive encyclopedia data to back this up. And natural gas is one of the unsung heroes of the growth of data centers and AI. Because if you look at the report, Elon's even spoken about this. Without natural gas, the generative AI that we have today, plain and simple, it's not working. And I don't feel, this is my humble opinion, that the industry gets enough credit for that.
Well, I think you're right. I would agree that right now it's an enabler. It's also a stabilizer. It's providing both for growth and flexibility. Flexibility is really the key to keeping grids working. In Texas, we have the most uh, wind generation in the country, and right neck and neck with California in terms of solar generation. That introduces a nation leading amount of intermittency, when you get into evenings or when the wind isn't blowing. Natural gas is really the thing that's flexing. So we can go from, on average, maybe 40 to 50% of power across the year coming from natural gas to that being literally, we've had days where you've got specific hours where it's as much as 98% of the power on the grid that's been coming in the ERCOT grid from natural gas. So the ability to go to flex from almost nothing to 98% in a short period of time, that's what's required to keep the grid stable. And that routinely happens, and this is something in our weekly chart book that we monitor each and every week. It's something that we keep track of because it's part of the value proposition for the industry.
I mean, there's a lot of value in Texas, and you have this great line. You've called Texas a global stabilizer because the U.S. actually is on track to surpass Russia as the world's largest gas exporter. That's impressive. Now, because you're an economist, I have to ask the economist question. What impact will that have on Texas' growing economy? And I bold that because the economy in Texas is continuing to grow.
Look, without hyperbole, it is core strength and resilience for Texas economy. We just came out earlier this month with our annual energy and economic impact report as the Texas Oil and Gas Association. And it may not surprise you, but we produced and offered to the state between state and local royalties and taxes paid $27 billion, just over. That's the amount of state and local tax that was contributed. And royalties. That alone exceeds the total tax receipts of 34 individual states, if you want to put it in perspective, just coming from one industry in Texas. So that is by far, when you're comparing to the rest of the private sector on average in Texas, by far the biggest contributor. The tax burden for our industry is 7.5 times on average the rest of the private sector. So it really is holding it up. And again, we're at record levels and continuing to grow. We're seeing continued increase in resource recoveries, a lot of efficiencies. We're producing significantly more output over the last few years using 20% fewer rigs as well. So from an upstream perspective, it's been performing very strongly. When we move, and we talked about the pipeline expansions and the export terminal expansions, the market optionality that goes with that, you've got a business model fueled by a lot of capital investment that's fundamentally transforming the economy and how it serves both domestic and international markets. And then when we convert it through the manufacturing sector into things, it really is a sustained advantage to have cost-effective plastics and other materials that come from this that otherwise, when we're comparing to other nations that don't have this advantage, it really is hard to have that dedicated, steady, cost-effective supply chain that supports manufacturing and exports. So it's a continued strength both for the Texas and the U.S. economy. It's a sense of energy security. It's a long answer, but it comes down to it's truly a game changer for Texas and for the US.
It's a game changer, but at the end of the day, great policy is what enables the oil and natural gas industry to thrive in the state of Texas in the United States. And I want to dive more into the numbers. The 20% fewer rigs, and the upside of that, you produce 6% more petroleum. That's impressive. How much of that, because I got to put the Mr. Automation hat on, how much of that is driven by automation that's enabling that?
If we talk to service companies, they would say that traditional data analytics replacing experiential based judgment has been kind of the primary source of human capital difference in the process. The first order impact, and honestly the larger, is that the laterals, the amount of drilling length underground has continued to get longer. But even when you control per lateral foot and start looking at how much oil and gas you're getting per amount of production there, even as you go deeper into the resource base, you've continued to see increasing productivity. So that those productivity gains really are enduring. We haven't even hit the tip of the iceberg in terms of AI and things that could really continue to increase the recovery factors. If we went back a decade ago, people didn't really understand at a molecular level why hydraulic fracturing works the way it does. That continued increased understanding is resulting in higher recoveries of the resource in place of both oil and natural gas. That's the efficiency that we're seeing. And I still think that we should be bullish on the potential for Texas and the US to continue to produce more from the shale revolution for this reason. And this is interesting because when we look at the official outlook right now, what really changes in it is an assumption that by 2027, that this drops off, that the US starts to contract in terms of its production. That's not consistent with the official view of actually the statistics on productivity, which we're seeing continue to uh, increase at these strong levels.
Then if you look at me being me, if you look at data scientists, Houston, home to the oil and natural gas market, has one of the highest concentration of PhDs in artificial intelligence. So with that statistic out there, will we continue to see over the coming years and decades the oil and natural gas industry continue to invest in AI and automation techniques to enhance the recovery aspects and just overall efficiencies of their operations?
Absolutely, I think it's inevitable. I mean, you already see some positioning and branding by companies that are investing in the know-how to do that right now, bringing more data scientists for both above and below ground kinds of analytics. The IT infrastructure is getting built out. But this is an industry with many long-lived assets. So if you were visiting your average refinery, they have a legacy control system there's no AI in there, but these are the kinds of things that over time will continue to be changed out, upgraded. You would expect that there's upside that goes with that as well.
That's the business side, the oil and gas side. Now we have to shift to the other side because you do a really great job breaking this down in your weekly and quarterly reports. The U.S. consumer, and I want to highlight this here for you. 70% of real GDP and 90% of its growth in Q2 2025 was the US consumer. And now US households are sitting on, this is scary, a record amount of debt, 18.6 trillion. That's trillion with a T. I didn't misquote that there. That's in your report. That's of Q3 2025, according to the New York Fed. That's scary. If consumer spending slows, what impact does that have on the oil and natural gas markets?
So let's, for the audience, give some perspective on why we look at this. There's a base case, and we're looking at the official views on the economy, oil and gas markets, and then overlaying our sentiment about what we really think of that. And the economy writ large has been growing at a pretty healthy clip here. Now, when we take it apart, consumerism has held it up in past quarters, and it's one of the risk factors going forward. The University of Michigan's Consumer Sentiment Survey, historically, consumer sentiment has had a pretty good correlation, a strong correlation with changes year over year in the amount of consumer spending. And in the University of Michigan survey, consumer sentiment's been historically low. So we've seen some challenging statistics coming out in terms of forward-looking indicators of consumer sentiment, inflation expectations, and how people feel about their wealth. And it differs by income segment. We know that higher income households have held up consumption, but when we look forward, there is a point at which when we realize that asset markets, stock market in particular, at record levels, that continuing to hold up the perception of wealth has been really key to continuing to grow spending at the clip that we have been. So these are the risk factors. This is what could change when we start saying, well, when we have the geopolitical issue or the political issue of the day, if that ends up affecting asset market values, if we start looking at what's happening with inflation and interest rates, what are the scenarios that could lead to catalysts of change in terms of the macroeconomy? Directionally, if we saw a slowing in the economy or a downward shock, for transportation, that definitely means some softening demand at the margin. Keep in mind that we've been at record levels and growing. So the rule of thumb is if the global economy is growing 2 to 3% on a market exchange rate basis, divide by 2 and in million barrels per day, that's roughly the amount of growth that you will see in terms of oil demand globally. That's held up in recent years, where if you're growing at 2.5%, you're needing 1.2, 1.3 million barrels per day more oil in the present year compared with the past year. EIA sees that slowing here, and we will see if that plays out. Right now, we have a good problem to have in the sense that the supply has more than kept up with this record demand. And we need to see if the demand on the margin does slow here, if there is this kind of shock that manifests. These are the scenarios. Again, the base case is that we have pretty solid growth, and we see indications, especially with tax policy coming this year, there'll be a lot of stimulus in the U.S. economy. There are reasons for optimism as well, but we'd be negligent not to represent what we think the risks are as well.
You have to look at there was one thing that really stood out to me. This was on Delta's latest earnings call, which they revealed that coach fares in terms of fares that they're charging and in terms of passengers are down. Well, business class is up and they're charging more, and that's what's getting the airline to profitability. It's like, oh boy, that goes in that whole K-shaped recovery that we're seeing there. So if the average consumer, the consumer psyche, they're feeling okay, the stock market's down 2%. Whoa, 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 and they start pulling back. That's a risk. And then also, I'm also watching the inflation in the hospitality industry is getting pretty much, in my opinion, out of control. And you're going to start to see consumers are going to rebel and not pay those prices. So you're watching all of those, if you want to call them consumer issues, and also grocery stores to see what potential impact that could have on oil and natural gas demand.
It's a great point and a great question. I do look at the details of what's happening with price inflation, both at the wholesale level and consumer price retail inflation as well. And it's interesting. You can't really take one anecdote and go and leverage the whole outlook off of that. But you do start to see that there are cracks in that. And there's been a debate among the economist community, honestly, about how much of trade and tariff effects would flow through and when. Um, I think my learning, if I were going back a year and saying, okay, what we learn? Well, what we learned is that there are a lot of levers and degrees of freedom in the system. And we've seen how, for example, exports from China have very creatively found different export platforms around the world to be re-exported or rebranded, or supply chains could adapt. In some cases, you have producers that have eaten some of the impact of those tariffs. In others, you've seen currency changes, depreciation of foreign currency absorb some of that as well. There's also gamesmanship in the process where the declared customs value may be manipulated or changed, and you have to have an enforcement mechanism to actually stay on top of that. So between all these different things, we haven't seen the inflationary impact of those trade policies as we might have expected, but yet we have inflation that, I mean, to the month it's 2.7% year on year, but before that closer to 3. And we need to see what continues to come out of that. It's one of the scenarios that really could determine one macro-wise whether we sustain the level of growth and stability that we've come to expect.
There's a lot of data to digest. That's the bottom line that we can all agree on. And you do a really fantastic job with your weekly reports and your quarter reports. And we love having you on each and every quarter to break down the oil and natural gas markets. Dean, over the next quarter, obviously there's geopolitical issues we need to watch. That's well known. But what else do we need to look for in the oil and natural gas markets before we have you on again next quarter?
With oil markets, I'm really watching the global balance and whether things play out to official expectations. Both the International Energy Agency and the Energy Information Administration in the US have a protracted view of global oversupply. And part of that's a behavioral assumption on how they think OPEC will respond to these market conditions. Part of it is that in their way of modeling it, if they see a lower price environment emerging, there's a feedback effect where US production in their model starts to decline. From a ground up perspective, looking at the productivity numbers, looking at how the companies are behaving, we don't see that. So that's an interesting divergence. And interestingly, when we look at futures markets, they don't seem to see it or factor that in just yet either. So futures for oil, West Texas Intermediate, are sitting north of $58 per barrel currently, all the way through 2027, 2028. That's a sign that the market is viewed by at least financial markets as being in equilibrium. On the natural gas side, in the last few weeks, we've gone to some prices just north of $3 per million BTU, whereas 6 to 8 weeks prior, it was above $5 per million BTU at one point. So a really big drop. And when we apply analytics to this, that was a drop that was popping out as abnormally low. And flagging that in the report, we've seen to the day this morning, and this will vary day by day, where it's starting to correct a bit. So we need to see if natural gas with the infrastructure expansions medium term that we're looking at here, and again, 22 billion cubic feet per day of new egress that's under construction. This is not speculative. That coupled with the exportability, and we're producing so much that we can serve both domestic and international markets. It really is an exciting time for both Texas and U.S. energy, and these are the changes to watch.
There's a lot of changes to watch. It is an exciting time for energy, and we mostly focus this podcast on autonomy, but without energy, autonomy doesn't happen, automation doesn't happen. Energy is the backbone. The future is bright, the future is autonomous, the future is Texas oil and natural gas. Dean, as always, sir, thank you so much for coming on the road to autonomy, and I can't wait for next quarter.
Thanks, Grayson. Great talking with you.